Have you ever wanted to achieve financial freedom, to live life on your terms without worrying about money? Investing is your path to making those dreams a reality. It's about taking control of your finances and building a brighter future for yourself and your loved ones. Investing is not just for the wealthy. It's for everyone who wants to see their money grow over time. Think of it as planting seeds for a future harvest. The sooner you start, the more abundant your harvest will be. You work hard for your money, so put it to work for you. Investing allows your money to generate more money through interest, dividends, and appreciation. It's the magic of compound growth, and it's a powerful tool for building wealth. So, are you ready to embark on this exciting journey? Let's dive in and explore the fundamentals of investing together. Before we go any further, let's clarify the difference between saving and investing. Both are crucial for financial well-being, but they serve different purposes. Saving is like putting money aside for a rainy day. You park it in a safe place, like a savings account, where it earns a small amount of interest. It's your emergency fund, your safety net. Investing, on the other hand, is about putting your money to work in assets that have the potential to grow significantly over time. Think of it like planting a seed and nurturing it into a mighty tree. You need both a solid savings foundation and a diversified investment portfolio. One protects you in the short term, while the other helps you build wealth in the long term. Remember, the goal is to grow your money, not just watch it sit there. Before you invest a single dollar, take some time to think about your financial goals. What do you want to achieve with your money? Are you saving for a down payment on a house, your children's education, a comfortable retirement? Your goals will guide your investment decisions. For instance, if you're saving for a short-term goal, like a down payment on a house in a few years, you'll want to choose investments that are less risky and provide more stable returns. On the other hand, if you're investing for a long-term goal, like retirement decades away, you have more time to ride out market fluctuations and can consider investments with higher growth potential. Write down your goals, both short-term and long-term. Be specific about the amount of money you need and the time frame for achieving each goal. This will give you a roadmap for your investment journey. Investing is not about getting rich quick. It's a long-term strategy that requires patience and discipline. It's about building wealth over time through consistent saving and smart decision-making. This means making informed choices and understanding the risks and rewards associated with different types of investments. And the foundation of all of that is a solid budget. A well-structured budget helps you manage your money effectively, ensuring that you live within your means while still setting aside funds for future investments. A budget is simply a plan for your money. It outlines your income and expenses, helping you to allocate funds appropriately and avoid unnecessary debt. It helps you track your income and expenses so you can see where your money is going and identify areas where you can save more and invest more. By keeping a close eye on your spending, you can make more informed financial decisions. Start by tracking your spending for a month. This will give you a clear picture of your financial habits and highlight areas where you might be overspending. Write down every dollar you spend, no matter how small. This includes everything from your morning coffee to your monthly rent. Then, categorize your expenses into needs and wants. This distinction is crucial for understanding where you can cut back. Needs are essential expenses like housing, food, and transportation. These are the non-negotiables that you must budget for first. Wants are things you can live without, like eating out, entertainment, and luxury items. These are the areas where you have the most flexibility to cut back. Once you have a clear picture of your spending habits, you can start making adjustments. This might mean cutting back on non-essential expenses and finding more cost-effective alternatives. Look for areas where you can cut back on wants and redirect that money towards your investment goals. Every small saving can add up over time, significantly boosting your investment potential. Remember, every dollar you invest is a dollar working for you, earning you more money in the long run. The key is to start early and be consistent, allowing your investments to grow and compound over time. Section 5. Risk. Understanding the ups and downs. Investing always involves some degree of risk. The value of your investments can go up or down, and there's always the possibility that you could lose money. However, understanding risk is key to making informed investment decisions. Different types of investments carry different levels of risk. For example, stocks are generally considered riskier than bonds, but they also have the potential for higher returns. Your risk tolerance is your ability to handle fluctuations in the value of your investments. It's influenced by factors like your age, financial situation, investment goals, and personal comfort level with risk. If you're risk-averse, you'll want to choose investments that are less volatile, even if it means potentially sacrificing some growth. If you're comfortable with more risk, you can consider investments with higher growth potential. The key is to find the right balance of risk and reward for your individual circumstances. Section 6. Diversification. Don't put all your eggs in one basket. You've probably heard the saying, don't put all your eggs in one basket. This age-old advice is particularly relevant in the world of investing, where the stakes can be high and the market unpredictable. That's especially true when it comes to investing. The financial markets can be volatile, and putting all your money into a single investment can be risky. Diversification means spreading your money across different asset classes. This strategy helps to mitigate risk and can lead to more stable returns over time. Asset classes are broad categories of investments such as stocks, which represent ownership in a company, bonds, which are essentially loans to a company or government, and real estate, which involves property investments. Each asset class has its own unique risk and return characteristics. Stocks might offer high returns but come with higher risk, while bonds are generally safer but offer lower returns. By diversifying your investments, you reduce the risk of losing all your money if one investment performs poorly. This approach helps to balance the potential for growth with the need for security. For example, if you invest all your money in a single stock and that company goes bankrupt, you could lose everything. This scenario underscores the importance of not putting all your eggs in one basket. But if you spread your money across different stocks, bonds, and other assets, the impact of one bad investment will be minimized. Diversification acts as a safety net, cushioning the blow of any single investment's poor performance. A well-diversified portfolio should include a mix of different asset classes such as stocks, bonds, and real estate, as well as investments within each asset class. This means not just owning different types of assets but also diversifying within those types. This helps to ensure that your portfolio is well-balanced and can weather market storms. By spreading your investments, you create a more resilient financial future. Section 7. Time, your greatest asset in investing. When it comes to investing, time is your greatest ally. The earlier you start, the more time your money has to grow. Even small amounts of money invested consistently over time can add up to significant wealth thanks to the power of compound interest. Compound interest is the interest you earn on your initial investment, plus the interest you earn on your accumulated interest. It's like a snowball effect. As your money grows, it earns even more money, and so on. The longer your money is invested, the more time it has to compound. That's why it's so important to start investing as early as possible. Even if you can only afford to invest a small amount each month, don't underestimate the power of compound growth. It's the key to building long-term wealth. Section 8. Exploring the investment universe. Now that you understand the basics of investing, let's explore some of the different types of investments available to you. Each type of investment has its own characteristics, benefits, and risks, and understanding these can help you make more informed decisions. Stocks represent ownership in a company. When you buy stock, you're buying a small piece of that company, known as a share. Stocks can be an exciting investment because they offer the potential for significant growth. When you buy stock, you're buying a small piece of that company. This means you become a shareholder and can benefit from the company's success through price appreciation and dividends. Stocks can be volatile in the short term, but they offer the potential for high returns over the long term. It's important to be prepared for the ups and downs of the market and to have a long-term perspective. Bonds are loans you make to governments or corporations. When you buy a bond, you're lending money to the issuer for a fixed period of time at a fixed interest rate. Bonds are often considered a safer investment compared to stocks. When you buy a bond, you're lending money to the issuer for a fixed period of time at a fixed interest rate. This means you will receive regular interest payments and get your principal back at the end of the term. Bonds are generally considered less risky than stocks. They can provide a steady income stream and are often used to diversify a portfolio and reduce overall risk. Mutual funds and exchange-traded funds, or ETFs, are investment vehicles that pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. They offer a convenient way to invest in a broad range of securities without having to pick individual stocks or bonds. They offer a convenient way to diversify your portfolio without having to buy individual securities. This diversification can help reduce risk and improve the potential for returns. Real estate can be a good investment, but it can also be illiquid. This means it can be harder to sell quickly if you need access to your money. However, Real estate can provide steady rental income and potential for property value appreciation. It's important to do your research and understand the risks before investing in real estate. Consider factors like location, market conditions, and property management before making a decision. These are just a few of the many investment options available. Each type of investment has its own set of risks and rewards, and it's important to choose the ones that align with your financial goals and risk tolerance. The best investments for you will depend on your individual circumstances, risk tolerance, and investment goals. Always consider seeking advice from a financial advisor to help you navigate the investment universe and make informed decisions. Section 9. Start small, dream big. The power of compound growth. You don't need a lot of money to start investing. In fact, you can get started with as little as $50 a month. The most important thing is to start now and be consistent. Open an investment account with a reputable brokerage firm. Then set up automatic investments so that a fixed amount of money is transferred from your checking account to your investment account each month. Once you've set up automatic investments, the key is to be patient and let compound growth work its magic. Don't panic if the market takes a dip. Remember, you're investing for the long term. Investing is a journey, not a sprint. There will be ups and downs along the way, but by staying the course, diversifying your investments, and taking advantage of compound growth, you can achieve your financial goals and build a brighter future for yourself and your loved ones. In Ecclesiastes 11:2 it says, "Invest in 7 ventures, yes, in 8. You do not know what disaster may come upon the land." This reminds us of the importance of diversifying our investments to safeguard our financial future. Ready to start your investment journey? In the description of this video, you will find useful materials that will help you out. Don't forget to like, subscribe, and share this video with someone who could benefit from understanding the basics of investing. Thanks for watching, and I'll see you in the next video.